All right, here's our data for Anne's flowers, right? Notice when they gave us the estimated life, they gave it both in years and in units, or in this case, miles. That way we could use either method. So let's go ahead and calculate depreciation with our second depreciation method. Okay, again, there's those two steps. And again, you're free to pause the video and then see if you were able to get it. Cost, we said our cost was $42,000. Salvage value is given at 9, and your estimated miles is 100,000. That gives you a depreciation expense per unit of 0.33. Okay. The second step, we said, is to take your depreciation expense per unit, multiply it by your actual units. Okay, so they have to give us some additional information here. We need to know how many miles did they drive in 2020. Okay, that's on the next slide for me. It's on the handout for you. Okay, so for 2020, it was 35,000 miles. So this is for 2020. That gives us depreciation expense of $11,550. Okay, so if we were doing our journal entry at December 31st, we know our accounts. And now we know our amount would be $11,550. Let's try one more year, just so that you can see one important thing. This depreciation expense per unit doesn't change. I have students that like to update this calculation every year. It doesn't change. Okay, so for 2021, the expense per unit is the same you calculated previously. What does change is the usage. In 2021, we only drove 25,000 miles. Okay. Or 8,250. Okay, so I just wanted to illustrate that. And if we were to again calculate it for 2022, the depreciation expense per unit doesn't change. What changes is your actual units. If we were to graph the units of activity depreciation method, it would be different each year, right? Year 1, 2, 3, because it just varies on usage. So this one's going to kind of change. Whereas straight line, we said it's a straight line, and you'll see what happens with our third method. Okay, so a company might use this method if they want to have the best matching of expenses and revenue. They'd probably also be using the LIFO inventory costing method, and probably percent of sales uncollectible accounts, right? Just so all of their methods, all their calculations align with what their goal is. All right, good job. In the next video, we will see the double declining method.